Welcome to our HighRock clients and any other listeners who have joined us this week. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar, so those who can't join us live can tune in when it is more convenient. I'm Scott Thomason, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Thomason, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Well, let's review quickly our themes for 2016 before we get started on what happened last week. Now, our key theme for 2016 is that financial markets will be volatile, and so far that has been playing itself out. There is a big question mark surrounding the U.S. economy. Will it follow the U.S. Federal Reserve's more optimistic outlook, or are less positive global forces going to pull it down? Commodity prices, and especially oil, are having a deflationary impact. Can non-commodity prices offset this? Central banks of Europe, Japan, and China are adding stimulus. The Bank of Canada and the Bank of England are holding steady, and the U.S. Fed is tightening policy. Now, this is a recipe for possibly greater uncertainty. Throw in the geopolitical wildcards like the Middle East, Russia, and the UK leaving the European Union. As always, as they have been, bond markets will hold the clues for us, so we will keep a close watch on them. Equity markets, we think, remain expensive, although somewhat less so than they were last May. And, of course, we do still remain in a time of lower than average returns after 6 years of above average returns, and as all things do over time, we are moving back toward the longer term averages. So what's happened since our last webinar? Let's go right to the financial markets because there has been a lot happening. In keeping with our key theme for 2016, it has been a wild ride since the beginning of this year. Volatility spiked in the 30-minute period last Wednesday, and after leveling off, jumped to start the week yesterday. Oil prices are currently driving investor behavior because investors are fearful of the insolvency of oil producers and the impact that it might have on the financial system and in all risk assets. Volatility remains well above the long-term averages, but well below the spike we saw last August and the previous spikes from 2008, 2010, and 2011. CNN Money's Fear and Greed Index hit a low near 9 a few weeks ago, representing extreme fear before it bounced higher, currently sitting at 20 today. But things did not get as fearful as they did last August, and that is so far anyway. Our benchmark world equity index was weaker by about 2.5% on the week and is now lower by close to 10% on the year. The TSX was the best performer since last Tuesday. Japanese stocks were the worst performer. In December of last year on BNN's The Close, I suggested it might be a reasonable strategy for 2016 to be overweight the underperforming Canadian equity market and underweight the outperforming U.S. equity market for rebalancing purposes. At this time, that strategy appears to be working by close to 4%. However, yesterday it was closer to 6% before today's oil price collapse and the negative impact on the TSX. Well, our benchmark world equity index made new lows near 49 a few weeks ago, an approximate 22% drop from the highs before it found buying support from short covering and a little value investing after such a great decline. The downtrend, however, remains intact as we are now experiencing lower lows and lower highs. A test of further buying support at the 49 level should give us an indication of whether or not this level will hold any significance. We came close to those levels today before things bounced. However, until this pattern and downtrend is broken, we should be on guard for further selling pressure from those who are giving up hope. We will use better values to nibble away at this opportunity, although we are still sticking to our overweight cash thesis. Importantly, it is crucial for the U.S. equity market to hold the long-established uptrend from 2009. A breakdown of this trend would likely bring further selling that could take us back to the 2007 highs near 1575 on the S&P 500. The S&P 500 is down by close to 15% at current levels, and the 1575 level would take us down by another 10 to 11% from the highs. So we're monitoring developments here closely. Canadian and U.S. bonds were stronger this week. U.S. high yields were a little weaker. The U.S. and Canada 10-year bond yield spread narrowed by 4 more basis points this week as the U.S. yields continue to fall faster than Canadian yields as the flight to higher quality assets picked up some momentum over the course of the week. Oil was hit today after the latest International Energy Agency report. Interestingly enough, on the week, gold was higher. Commodity prices are off of their lows, but the trend continues down. The past month featured the return of Iranian oil after European sanctions were lifted and the failure of the Organization of the Petroleum Exporting Countries to agree on production levels. The OPEC flooded the market with an additional 280,000 barrels a day last month, according to the International Energy Agency. And today, they announced that supply levels for 2016 will be higher than originally forecast. And that pushed oil prices down once again. For the moment, the downtrend obviously remains well entrenched. The Canadian dollar moved higher last Wednesday and Thursday with a huge 2.5-cent move as oil prices rebounded. However, that situation did not last, and as you can see from today, we see Canadian dollar a little bit weaker. 3 weeks ago, the Canadian dollar hit levels not seen since March of 2003 in anticipation of further easing of interest rates by the Bank of Canada, but they held rates steady, and the Canadian dollar has subsequently improved. The Bank of Canada wants to see what fiscal policy measures the government will take before making any changes to its monetary policy. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. The U.S. Federal Reserve raised interest rates in mid-December and held them steady in January, citing that they saw improving labor market conditions and increasing household and business spending, but were concerned with exports and global economic and financial developments, which is code for higher levels of volatility around the world. As you all know, this is our key theme for 2016. The next meeting will be in March. If current conditions persist, we expect that this will likely keep the Fed from raising interest rates. However, we are certainly at the whim of the Federal Reserve on this. Fed Vice Chairman Stanley Fischer suggested higher degrees of uncertainty are persisting. Back in December, the Fed had a particularly optimistic economic outlook. U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. Well, the Fed's key inflation metric remains stuck well below the target 2% level and likely will not move much as commodity prices hold it back. The Fed suggests that this is transitory and likely to fade in time to let inflation data move higher, but they have been using the transitory word for well over a year now, and little has changed in that time. On the other side of the coin, last Friday gave us a mixed employment report for January. The non-farm payrolls increased 150,000 versus expectations for closer to 190,000. December was revised lower. November was revised higher by about the same amount, so they offset. But signs of strength came as the unemployment rate fell 1/10 to 4.9%, and the participation rate rose 1/10 to 62.7. Now, this combination indicates that more people are getting jobs and more people are coming into the workforce. Another sign of strength, the average work week rose to 34.6 hours, and average hourly earnings, boosted by state-level minimum wage hikes, rose considerably sharp, 0.5%, though the monthly gain didn't make for any change in the year-on-year rate, which holds steady at a still modest 2.5%. So seeing wage gains, seeing lower unemployment, and certainly that's something that is part of the Fed's mandate, so it does make their decision and create even a greater dilemma for them when they meet again in March. Now, a more worthy leading indicator that we watch of unemployment is the weekly jobless claims report, and that continues to show an unhealthy increasing trend. The consumer, 70% of the U.S. economy, is definitely confident, but according to the surveys, but there is a gap between their confidence and their spending. We'll see the next retail sales report for January on Friday of this week. Meanwhile, manufacturing in the U.S. is in its 4th month of contraction, which is certainly a fairly significant concern. As we are more concerned with what to expect in the future, the GDP now forecast for U.S. GDP in the first quarter of 2016 jumped over the course of the week to 2.2% as employment data has strengthened expectations for consumer spending. For the moment, the U.S. economy is showing signs that it may be holding up to the difficulties being experienced in the global economy. And as I said, this might create a dilemma for the U.S. Federal Reserve when it meets in March. Fed Chair Janet Yellen will be testifying before Congress and the Senate tomorrow and Thursday, and of course, this will be monitored closely by financial markets. So what's happening with the global economy? Well, euro area companies represent about 16% of the world equity index, that is our benchmark. The European Central Bank eased monetary policy on December the 3rd, but was less stimulative than the market had expected. And 3 weeks ago, amidst the increasing market volatility, President Mario Draghi surprised the market with an announcement of more stimulus to come in March. That halted the selling and brought buyers back into the equity markets. We remain vigilant as to what new measures the European Central Bank will bring in March. Well, it's been a difficult year for European banks, especially Deutsche Bank, whose stock has fallen close to 40% this year. Not only do they have risk exposure, but will have significant legal bills to pay over a number of high-profile legal scandals that they've been involved in. Now, post the 2008 financial crisis, the Basel Committee on Banking Supervision, a global voluntary regulatory framework on bank capital adequacy, stress testing, and market liquidity risk, adjusted capital requirements for banks, and that's known as Basel III. In effect, regulations were put into place to ensure that banks had enough capital to cover their risk so as to avoid another financial crisis. Securities that were issued to raise capital levels for this purpose were called contingent convertible capital securities. In essence, the bank regulator can, if it anticipates default on these securities, force a conversion of these securities to common shares. Now, more common shares increases the dilution to existing shareholders and pushes values and prices of the equity or the shares lower. Therefore, as the probability of default arises, there is a greater potential volatility. Back to our theme of greater volatility and uncertainty. And Deutsche Bank shares are and have been a prime example of this. Well, obviously that means that we have to understand the probability of default. That is the debate at the moment. What is the exposure of banks to commodity and oil producers, and especially emerging economies? It is not entirely clear, and that lack of clarity continues to add further to the levels of uncertainty that exist today. Well, Japanese companies represent 8% of the World Equity Index. In a surprise decision 2 weeks ago, the Bank of Japan, following the European Central Bank's path, chose to introduce a negative interest rate, aiming to achieve a price stability target of 2% inflation and hope to drive investors out of safe investments like government bonds. Well, last week we focused on negative interest rates. In essence, what the Bank of Japan and the European central banks are doing, trying to do, is drive money away from their currencies and into currencies with higher interest rates, specifically the US dollar. This helps to devalue their currencies and make their export economies more productive. Well, this should help add some domestic inflation to counter the impact of the current global commodity price deflation. The problem is that they are exporting the deflation to the U.S., which has a structurally stronger domestic economy because of demographics, but will in turn drag the U.S. economy down, so as not to necessarily so it is not necessarily beneficial on a global scale, and to date the domestic benefits have shown to be marginal at best. And interestingly enough, over the course of the week, and we'll see this more in detail in a moment, but in fact the Japanese situation has not been driving driving investors into higher risk. They've been driving them further into Japanese government bonds, and we'll have a look at what's been going on in a second. Now, with this attempt to force investors to move to riskier assets, to chase higher returns, and to add buying pressure to reduce volatility. However, again, this is only a temporary reprieve. If the global growth does not add to corporate profitability over time, then the fundamentals don't warrant the investment, and of course, anxiety returns. It also encourages borrowing at lower interest rates. But as we have often said in the past, it now takes 10 times the amount of debt to get the same incremental increase in GDP as it did 10 years ago. So debt building is less efficient. At the moment, the global debt burden is at record levels, and the commodity price deflation is threatening to turn much of this bad debt into bad debt, which may put even more pressure on the financial system. Of course, this can all hurt bank profitability as banks' spreads between their borrowing costs and lending revenues decline, which certainly heightens concern of default on the contingent convertible capital securities that I was talking about, and then that plays right back to our key theme of higher levels of volatility for 2016. Okay, back to the global economy. Companies in the UK represent 7% of the global equity index. The Bank of England Monetary Policy Committee voted unanimously to maintain the bank rate at 0.5% on February the 4th. One policymaker had been voting for a rate hike since last summer, but dropped that call as growth and inflation forecasts were lowered, signaling rates are likely to remain at record low for at least this year. Policymakers expect inflation to remain below 1%. GDP forecasts were lowered to 2.2% for 2016 and to 2.4% for 2017. Last week we discussed the UK and their participation in the European Union ahead of a referendum that may come as soon as June, and the significant economic risks to a UK exit. Well, there's three shocks to the economy, potentially. One is the confidence shock, which would create uncertainty over post-exit arrangements and means business investment would slip and household savings increase, reducing demand and negatively impacting the UK economy. The credit shock is UK banks are seen as riskier and their borrowing costs would increase. And finally, the currency shock that would see foreign direct investment flows drying up over the course of a year. Even before that, investors will reassess the risks associated with Britain's large current account deficit, and the currency can depreciate significantly. We are monitoring this situation and waiting for further developments on this front, monitoring it very closely. Chinese companies represent 2.5% of the World Equity Index. Chinese markets have been closed for the Lunar New Year holiday. In Canada, where companies represent 3% of the world index last week, Canada's employment data was little changed, but unemployment was up to about 7.2%. There were fewer people working in Alberta, Manitoba, Newfoundland, and Labrador. On the other hand, Ontario was the lone province with an employment increase. Employment declined in agriculture, manufacturing, transportation and warehousing, and public administration, where there were more people working in information, culture, and recreation, as well as in the other services category. So what do we see on the horizon? Well, bond markets, as we know, lead other financial markets, so let's check in what's going on there. As I mentioned before, negative interest rate policy in Japan, and of course that in Europe have pushed Japanese and German yields on short-date maturities lower. In fact, Japanese rates are negative all the way out to the 10-year area. The Bank of Japan is trying to manipulate the yield curve into a positive slope, as is the European Central Bank, to project expectations for economic growth and greater inflation. Now, as the US, UK, and Canada, the slopes are still positive, but have been flattening considerably with lower, long-dated yields and shorter-dated maturities for the UK and Canada flattening. It does show near-term economic weakness is to be expected, as well as a move, as I mentioned earlier, to more quality assets from riskier assets. So still plenty of uncertainty out there, and that's what we're seeing from our bond yield curves. The spread of or yield difference between investment-grade corporate bonds and safer government bonds has also been widening as investors move away from riskier assets and are, as I said, driving short-term government yields lower and in many cases into negative territory. In fact, the amount of government bonds with negative yields has grown to close to 25% of bonds outstanding in the JP Morgan index. Investors are paying government's interest to safeguard their money. That is showing us very real concern out there. Credit default swaps are, in a nutshell, insurance against bond default. Buyers use these to hedge the risk of such an event. The higher cost for credit default swaps for Deutsche Bank, for example, are now back to 2011 levels as a result of the greater uncertainty. Comparatively, Bank of Tokyo, Mitsubishi, JP Morgan, and Royal Bank costs are up, but not as dramatically. Bond markets are getting less and less comfortable with risk, and we therefore need to remain defensive. High-yield bond markets lead equity markets, and that gap remains to be closed and makes equity markets look rather precarious at the moment. Well, let's check in with the equity markets. When investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average to price-earnings ratio is 14.2 times. The 12-month forward price-to-earnings ratio is currently at 15.4 times, higher than last week's 15.2. At the equity market highs back in May, it was at 17.1. Now, with 63% of companies reporting for the fourth quarter of 2015, the blended earnings decline for the fourth quarter is a negative 3.8% this week, which is smaller than the blended earnings decline of 4.6% last week. Upside earnings surprises reported by companies in multiple sectors over the course of last week, healthcare, information technology, and materials, all responsible for the decrease in the overall earnings decline for the index over the week. For all of 2016, analysts are predicting earnings increases of 4% and revenue growth of 2.2%. Well, last week we reported that those same analysts had been projecting a 5% earnings increase for 2016. So they've been lowering and revising lower their expectations. That, in essence, makes current share prices actually more overvalued. Remember that while equity prices, that's the green dotted line on the chart, have become cheaper in recent weeks, until they move below that blue line, the forward 12-month expected earnings, which are also in decline, we think that equity prices remain relatively expensive. As for the other value metric that we like to look at, enterprise value to earnings, S&P 500 companies are valued at current market prices at near 12 times. The long-term average is 10 times, and that is just too expensive for our tastes at the moment. But when investors borrow to invest, they can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May, continuing lower now. It is something that inspires further caution. When the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign that that fewer and fewer companies are gaining in strength, and that is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. When markets fell recently, that gap narrowed considerably. Last week, we noted that large cap markets had rebounded, but not the small cap markets. This week, the gap has narrowed again, so perhaps the fall in large cap markets is perhaps temporarily overdone. Well, what does it all mean? Last May, we took a defensive posture to investing, and in light of our key theme for 2016, we do continue to remain defensive. We do see some value beginning to appear, and our expertise has been recognized by the leading financial press, as our co-founder and co-managing partner, Paul, explained to Bloomberg last week. Also picked up by the Globe and Mail for a story in their online investing section. There may be good buying opportunities for investors willing to do their homework. Well, at HighRock, we do our homework for our investors. Central bankers and most economic forecasters are uncertain of the path of the global economy. So are we. And as Paul suggested in the Globe and Mail article, we are quite fearful of the prospect of deflation in commodity prices. Our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to stay fully invested and at all times. That is why most advisors recommend sitting tight on a fully invested strategy. In many cases, it is significantly more difficult to adjust assets and positions one household at a time, as non-discretionary advisors are required to do that. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, more impactful, and that we find to be significantly better for our clients. Cash and cash equivalents have been important defensive assets, so we are carrying greater than normal cash balances in our models. However, with equity market values having fallen so rapidly to begin 2016, we have begun to find some opportunities to add reasonably cheap assets. Now, this does not change our defensive strategy. We are being patient and adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get it. If we don't, we can and will adjust our strategy quickly. Risk is significantly lower now than it was last May, about 22% lower according to our benchmark World Equity Index, so we are much more comfortable adding assets at levels where we do see value. Our HighRock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. Now, as volatility increases, the cash and client accounts, the underweight nature of our exposure to equity markets, and the negative correlations between equity markets and bond markets helps to mitigate the impact of volatility on our portfolios. So far this year, our global benchmark equity index is down by about 10%. And as I mentioned, as I did mention earlier, a typical 60% equity portfolio and 40% fixed income portfolio built with our models is down somewhere in the vicinity of 2.5%, depending on the individual structure of a client portfolio. Now, this is a significant mitigation of risk and volatility and is part of our ongoing active management. Okay, so what's up for next week? Well, as I mentioned, Fed Chair Janet Yellen will be testifying to the U.S. House of Representatives tomorrow and the Senate on Thursday. On Friday, we'll get Euro area fourth quarter GDP and Euro area January industrial production, and we will see U.S. retail sales to give us some inclination of what the consumer is up to. Over the weekend, we'll get Japanese fourth quarter GDP and the Chinese January balance of trade data. On Monday, it's Canadian and U.S. Holidays. Markets are closed. On Tuesday, our normal HIROC webinar will not take place. We will be traveling on that in the next day. So our next webinar will be Tuesday, February the 23rd. Well, that's it for today's discussion. If anyone who is listening might have a question, please feel free to ask it now. Okay, well, if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week, a great weekend. Happy Family Day to our Canadian listeners, and happy President's Day to our U.S. listeners. Don't forget to tune in 2 Tuesdays from now. Until then, this is Scott Thompson signing off.